In this module, we're going to discuss audits, reviews, and compilations, and the language and terms we use in each engagement. And they are three separate engagements with three separate sets of standards and perhaps disclosure. And we have to make sure that we're very clear and keep each separate, or we'll confuse ourselves and possibly others. Now, we have to make sure we do what is required. We have to do the minimum that is required. And the minimum required in an audit is pretty high, reviews a little lower, compilations we don't do much at all. But we've got to make sure that we keep each of those assignments to only what is required. So we should keep an audit to an audit and not do any more. And if we say, oh, well, the client would like us to do more and provide additional services, fine, as long as they're going to pay for it. But an audit should be kept to an audit. Now, a review should also be kept to a review, and we've got to be careful that we don't suddenly start slipping in audit stuff. Oh, let's do a confirmation in a review. Well, confirmations are not required unless there's a reason for it. So don't do that. So keep a review to inquiry and analytical procedures, and that's it. Don't start slipping in audit stuff. A compilation is a compilation. We do no work. We give no assurance. So we got to be careful that we don't start slipping in audit and review stuff, comparing this to that, concluding things. Compilation is a compilation. We do no work. We take what the client gives us, unless it's catastrophically and obviously wrong, we take what the client gives us. Now, we've got to be very careful to tell the client what each service entails, what they get out of an audit, how much assurance they get, how they can use it, review, compilation. If they want more, fine. If you would like us to do more stuff in an audit, provide more disclosure in the income statement of an audit than's required, we're happy to do that. Will you pay for it? And here's how we can do it. And we have to be very careful with the wording of the additional service. So if we provide additional service to the client in a review, we're going to have to be very careful to make sure that the client understands that we're not suddenly doing an audit, and anyone who gets that additional information in a review doesn't come to think that the review has suddenly turned into an audit. Now, disclosure in an audit, review, or compilation is different. Audit and review are the same. They're going to have to both be in accordance with GAAP. Depends what set of GAAP you're using. If you're using IFRS, a bit more. If you're using Canadian GAAP for private enterprises, for instance, a bit less perhaps. I'm going to use the income statement as an example. In an audit or review, there are 30 or more items that are required disclosure on the income statement. Probably more. I counted 30 in one section. So you have to be aware of what you have to disclose and make sure that it's disclosed if you're doing an audit or review. There are no rules in a compilation. And indeed, in a compilation, I might go out of my way not to provide GAAP disclosure because I want to give a very clear impression to anyone who gets their hands on compiled financial statements that they're not GAAP, that I haven't done an audit or review. It's a compilation. I've taken information given to me by the client, put it in the form of a financial statement, and I've done no work and given no assurance. Now, because the purpose of compiled financial information is often to do a tax return for the owner-manager, and it's convenient to have depreciation disclosed, so you can do the tax return. I might have depreciation separate. Convenient to have income taxes separate, though current or future taxes are required in an audit or a review, not required in a compilation. I wouldn't calculate them because I'm doing work and I'm not required to. Now, revenues, there are various categories of revenues that we have to disclose. Sales, interest income, probably because we have to disclose major categories of revenue. Investment income, we have to. Same in an audit or review. Cost of goods sold, that's a bit tricky. We have to disclose cost of inventory sold. So you're going to have to figure out a way to do that. Either you disclose cost of inventory sold on the income statement, or you disclose cost of goods sold on the income statement, and then by way of a note, you disclose cost of inventory sold. Okay. Heat, light, power, water. We often have many categories on the financial statements of a smaller business. Often have heat, light, power, and water. In a large company, they'll be selling general and admin. They will not disclose those separately. Got to be a little careful how we do that, because we are perhaps, if we disclose those things, we are giving some level of assurance to a reader that we've got heat in heat and light in light and water in water, and we may not have done anything to check that. Wages are either in inventory or selling general and admin. Advertising is selling general and admin. Depreciation and income taxes have to be disclosed, current or future, in an audit or review, but not in a compilation. So you have to be sure to have all the required disclosure. Audit and review, you have a responsibility to have all the required disclosure. And in a compilation, as I said, I would have none of the required disclosure to make very clear that it's a compilation with no assurance. In both audit and review, you got to watch for too much. Are we disclosing heat, light, power, and water? We're sort of responsible for the categorization. If we have that categorization on the income statement, I can understand that a user might think that we've checked that heat is in heat and water is in water. And what's the difference between heat and power? I don't know. So we're sort of responsible for the categorization, and it takes us a long time to have this big, long 30 or 40 line income statement containing things that aren't required to be disclosed by GAAP. And we have this responsibility for categorization, and have we done work to make sure? So perhaps the solution is a simplified GAAP-only income statement and an unaudited schedule. That's something you're going to have to talk to your client about. Now, some other things that we might consider disclosing, for instance, and this only applies to audits and reviews. We have a situation where an owner-manager took too much, in quotes, in benefits, and I don't know what too much is. That's a value judgment that someone's making. But there's a lot of meals and entertainment, concert tickets, sports tickets expensed in the financial statements, and we are a bit puzzled by this. Well, all of that's disclosed in selling general and administration. The owner-manager owns, if this is very important, if the owner-manager owns the whole company, 100% of the shares, they can do whatever they want. They can expense whatever they want. You might have a taxable benefits discussion with the client and say, look, I think you have a problem, and I think you need to put some of this stuff as a taxable benefit. It's an expense of the company, but it might be taxable to you, and you might get in trouble. So you might want to have that discussion. You have a situation where staff stole office supplies. We don't care. As long as it's not in inventory of office supplies inventory and it's all been stolen, office supplies inventory isn't included in inventory. We found that staff are swiping office supplies like crazy. We don't care. It's in selling general and administration. Might be something we want to tell the client about. Oh, by the way, are you aware that your staff are stealing office supplies? Do you care? It's not a lot of money, but do you know about it? So that might be something we might put in the management letter, but it's not an issue for disclosure. Unauthorized payment for meals and entertainment. Staff are putting through meals and entertainment, and it's not being approved. Again, management letter, as long as senior management knows selling general and admin, as long as it's properly categorized for tax purposes and properly treated for tax purposes, that it's unauthorized, we don't care as an auditor. A manager took too much in benefits. Bought himself hockey tickets, bought himself concert tickets, lots and lots of meals and entertainment, private clubs, not approved. Now, for financial statement presentation, that's selling, general, and administration, it's no issue. Now, this is a manager. This is not someone who owns the entire company. They are treating themselves. Do the words charged with governance note, because they might want to have a talk with the manager. They might want to do something. They might consider it fraud. But for financial statement purposes, it's no issue. It's selling, general, and admin. Now, we have to remember there is no separate disclosure of fraud. It's an expense. Theft of merchandise by customers or by staff is an expense. It's not separately disclosed. The only objective, and people sometimes confuse this, is the effect of the fraud has to be removed from the financial statements. And people think, oh, we've got to get it completely out of the financial statements. It has to be removed from the income statement. Where do we put it? Well, it's an expense. It belongs in the income statement. The place it does not belong is on the balance sheet. So if the office supplies that were stolen are in inventory on the balance sheet, that's a problem. They have to be put to expense on the income statement. But the only objective is to remove it from the balance sheet and make sure it's in the income statement. Now, the language we use in audits, reviews, and compilations. Risk of material misstatement. Risk of material misstatement is an audit term, should not be used in a review. In a review, the term is material misstatement is likely. Now, sometimes we call it likely material misstatement, but technically it's material misstatement is likely, which is probable, not really well defined, but probable much more than 50%, maybe even more than 60%. I'm going to say, for instance, 75%. It's really quite likely. It's probable. Now, if material misstatement is not likely, we don't mention it. We determine and document if it is likely, otherwise we don't mention it. In an audit, risk of material misstatement being significant, again, not terribly well defined, 80%, like really high, almost certain to be there. Risk of material misstatement being high, audit literature says around 60%. The difference, I think, between high and significant, if you conclude risk of material misstatement is high, do some audit procedures and go, oh, look, there's nothing there. That's fine. If you say risk of material misstatement is significant, I think you've kind of decided that it's wrong and you're going to keep doing audit procedures until you find the right number. Risk of material misstatement moderate 50% and low 40%. Again, there's audit literature to support that. Do we have to document materiality in an audit? Yes. And the same thing has to be documented in a review. We document performance materiality in an audit, but we do not document it in a review. There's no mention of performance materiality. We only talk about materiality. Trivial, I'm going to talk about that in a second. It's actually clearly trivial, not trivial. Trivial and clearly trivial, I think, are different. Clearly trivial is smaller than trivial. And analytical procedures are done in an audit with an expectation as a procedure. No expectation if you're doing them as a risk assessment procedure. Analytical procedures are done in a review, but there's no requirement for an expectation, so don't document it. In a compilation, none of these words should be used because we're not looking for material misstatement or likely misstatement. Trivial analytical procedures, we're not doing any of that. None of that should be mentioned. Now, some people like to document clearly trivial at the beginning of the audit. That's not wrong. You have to document materiality. You have to document performance materiality. And if you want to document a clearly trivial threshold at the beginning of the audit, you can. But you can avoid that by never using the word. And this will, I guess, depend on your understanding of the client and how much you find wrong. Because in some clients, small clients, you never find anything wrong. So if that's the case, don't bother defining clearly trivial, define materiality and performance materiality, and then never use the word, and at the end evaluate all errors together and dismiss them as not material. And you may have a client where you know you never find much of anything, it's always well less than materiality. You could do that. You could also evaluate all errors if you don't want staff dismissing things as trivial in the audit because you're concerned that it might add up to too much. And again, this is going to be an audit where not that much is found. If you find smaller errors, put them all on the summary of unrecorded adjustments, whatever you call it, and then say, okay, these are trivial. I'm not going to worry about them. I'm not going to talk to the client about them. These are bigger than a bread box. I would really prefer that the client adjusted them. Let's go have a chat and see if we can't convince the client to adjust these not material but pretty big errors. So if you use the term, you have to document it, though it's in section 450, which is the evaluation phase. So you don't have to document it at the beginning. You can if you want. But if you use the term at the end, you have to document it. Now, be careful with this. Care in setting the level and in dismissing things as clearly trivial. You may want to have clearly trivial as $100 or $50 so that you're not dismissing stuff in the working papers that really could add up to rather a lot. Now, doing that also may be more work than ignoring it and doing it at the end. And abuse of clearly trivial or abuse of materiality. And let me show you an example, or tell you an example that I actually saw in practice. Now, this was a client that we took over from another auditing firm, and they had set materiality as $100,000, and they had found and had in the file a copy of a capital lease that they concluded was a capital lease, not an operating lease, and it was $50,000 against $100,000 materiality. And they dismissed that as not material. Now, I don't know, 50,000 against 100,000, that's an awful lot. I suppose at the very end, if that's the only thing you find, you might want to do that. I might want to talk to the client about it, but never mind, that's what they did. And then we turned the page and turned the next 50 pages where they had 50 leases photocopied and in the file, each of which they said was a capital lease, and each of which they dismissed as not material. $2.5 million in capital leases for trucks. Oops. And it was initialed by the senior, the manager, and the partner. So let me go back to my comment upon accumulating errors and dismissing them in the working paper. I would have suggested that they really needed to have accumulated all of these errors in a summary of unrecorded adjustments and then evaluated them all together, not individually dismissing them. So they did that individually against materiality. We have to be careful we don't do that also individually against trivial. Now, a compilation question, vacation pay. We have a compilation client and they have not recorded vacation pay. Might we say to the client, you know, vacation pay is a legitimate tax deduction. If you give us a list of what your vacation pay is, we will make a bookkeeping adjustment and record it for you and save tax. That's a totally legitimate tax deduction, a totally legitimate way to save a client's tax. Might be a question we would ask. And if you have a client where last year there was vacation pay accrued, we made a journal entry based on a client list and they haven't given us a list this year, might we ask the client, hey, you forgot to give us a list? And they would go, oh, you're right, we forgot, here it is. Now, how do we verify that this is the correct amount? And the first answer to that is we don't. we ask the question, is this the list management gave us? And if it is, we record it. If it wasn't recorded, we record it. And we go, that's the list management gave us. The only thing we would do to verify that the list is correct, because we don't do any work and we provide no assurance, is we would ask the question, does it look wildly incorrect? Last year it was 100,000, this year it's 2 million. Now our only option here, if we conclude that the 2 million is clearly wrong, and the client says, no, it's 2 million, our only course of action is to resign. Say, fine, if you want to record something that's clearly wildly incorrect, I quit. We don't do anything other than say we quit. Now, our conclusion on everything the client gave us, once at the end, just to save us time doing this, is I read the compiled information and it does not appear misleading. That's all we do, no work. So we do no work and give no assurance, none, zero. And we got to be really careful that we don't start checking that vacation pay is right, checking that the bank reconciliation is right. We're not required to do any of those things. Is this what the client gave us? Is it wildly incorrect? It's what the client gave us. It doesn't look wildly incorrect. On we go. So this is important because we want staff to be clear and to understand the difference in each of these three assignments and the difference in the level of assurance provided in each of these assignments. So we want them to, their thinking to be very clear and their use of language very clear. So when we're doing an audit, we're using audit language, audit procedures, and we're providing disclosures appropriate for an audit and a high, not absolute, but a high level of assurance. When we're doing a review, it's a moderate level of assurance, not necessarily well defined, but someplace in the middle, less than an audit. We are going to use review, not audit language, review, not audit procedures, and we will provide disclosure appropriate. Now, in an audit or review, disclosure is in accordance with GAAP, so the disclosure is going to be effectively the same in each assignment. When we're doing a compilation, it's not a low level of assurance, it's no assurance of any kind at all. No procedures are being done to verify the accuracy. All we're doing is documenting things like an engagement letter and like management representations. We're not doing any work. We are not providing any assurance. So our staff should be clear that we're using compilation language and never audit or review language. Compilation procedures, which are none. We're not going to do confirmations. We're not going to do inquiry. We're not going to do analytical procedures. We're doing no work. And we're providing compilation level disclosures, which are none, other than in Canada at least, an accounting policy note is required. I don't quite understand that because we have done absolutely no work to make sure that the policy note is correct. So it could be right or it could be wrong. Don't quite understand that, but there has to be a policy note, which can be pretty, doesn't have to be terribly specific, and we can make it clear that we've done no work to determine that it's correct. Now, what are the consequences of all this? The first thing we will do is we will confuse staff, and they will start doing an audit in a compilation or review. They will start doing too much work, and they'll be confused, and they'll be puzzled, and we'll be puzzled because we're going, how did work and process get so high? The other thing we will do, if we start requiring that people do more than they should, we will annoy staff. Staff who know what they were doing, either explicitly or just they're going, I just don't think this is right. Staff will start to get annoyed and they'll start to say, I don't want to do this anymore. Third thing we will do is waste time. And like as I said in point number 1, how come work in process is so high? Well, we wasted a lot of time doing a bunch of stuff that we didn't need to have done. The other thing we may be doing is, well, the client really likes it when we do this for them. Well, we're providing a service for free. Either no, or we'll do it, but there will be an additional fee for us doing what this additional thing you want done is. Number 5, this is down at the bottom of the list, but it's something we should worry about. If we start doing audit procedures in a compilation, will a lawyer be able to argue that we did an audit, not a compilation, and that the financial statements are material and misstated because we didn't do enough in our audit that we turned the compilation into, and therefore they will be able to successfully sue us? Now in Canada, back in the old notice to reader days, where the disclaimer was much clearer, there was still an awful lot of lawsuits, some successful, against accountants for waiver of notice, and they had to pay damages. Their insurance company paid damages in a compilation. So we have to be very careful in all 3 services that we're doing exactly what is required and no more. So people don't say, oh, this audit was, or this review was really an audit, or this compilation was really an audit, and you got it wrong and I suffered damages and you have to pay me. So be very careful about that. Anyway, thanks for listening.